Good morning, guys. This is Teacher Polite. Today we are going to be looking at the accounting cycle. So let's define what the accounting cycle is. So when you talk of the accounting cycle, it is a guideline which shows us how accounting information, how accounting data is gathered, collected, analyzed, and processed to give a meaningful set of information that can be used for decision making. So that is the accounting cycle. How do we gather? How do we collect? How do we receive and analyze the accounting data that we receive so that we can give a meaningful set of information that can be used by managers for decision making. So yeah, I'm going to draw a diagram for us to show the accounting cycle. So we start with a transaction and then followed by our source documents. Then next we have the journal. So it can be also box, will be referred to as box of original entry, or some books refer to them as subsidiary books. We are still talking about one and the same thing. Then we have the ledger and trial balance. And then lastly, we have final account. So this is the accounting cycle that we have. We start from a transaction. In our previous video, we talked about the transaction being the exchange of goods and services for money. Like that's a transaction. So then from the transaction, that transaction has to be recorded. So when we record a transaction, we are generating a source document. Then from the source document, we go on to the journals, which are the books of original entry or the subsidiary books, where we first record the information. Then from there, we have the ledger. And when we are talking about the ledger, we are talking about us now properly doing the bookkeeping, the accounting, and we use double entry in the ledger. We're going to look at those things in detail. Then the next thing is the trial balance. So in the trial balance, we are saying that we balance off the accounts in the ledger and we extract the balances, and those balances are the ones that we're going to use to create a trial balance. And lastly, we have the final account. So let's just quickly look at it. Okay, we defined a transaction already, and we said it involves the exchange of goods and services for money. Then from the transaction, we have the source documents that we have, and these are documents where the transaction is recorded. So examples of documents that we can have is we are talking about a receipt. We have a receipt. Maybe you paid for goods or for services, you get a receipt. Then number two, an invoice. An invoice normally is used when goods are bought on credit. Then EFT, these days, like people rarely use checks. We are using EFTs. So those EFTs, they can be like maybe messages or whatever. They are also a source document that, or a source of accounting information. Then in the previous, we had checks, we had check counterfoils, debit and credit notes. Okay, debit and credit notes, they are still working even today because they are used for returns. Like for example, if we sold goods to a customer and then the customer is not satisfied with the goods, maybe the goods are not the right type or whatever, they will send the goods back to us. So yeah, that is what we are talking about. So we have debit and credit notes. We are going to be looking at them in much more detail as we move on. Then from there, we have the journals. The journals or books of original entry are the books of prime entry where accounting information is best recorded, and we have 6 books of original entry. Namely, number 1 being the cash book. So number 1 book of original entry is the cash book, and the cash book is used to record all cash transactions. That is, we're talking about the cash that we received and the cash that we paid. So it consists of the bank and cash column. So the cash book is the only book of prime entry which acts as both the ledger and the journal. So the cash book acts as a ledger, at the same time it is a journal. It is a book of original entry, but also we complete double entry in it. Then number two journal is the sales journal. So the sales journal is used to record credit sales. When we sell goods on credit to customers, we record it in the sales journal. Then sales returns journal is used to record returns inwards. If we sell goods to customers and then they return them, we incur what you call sales returns. Those are sales returns, so they are recorded in the sales returns journal. Then purchases journal, it records credit purchases when we buy goods on credit from our suppliers. We record it in the purchases journal. And then if we return goods to the suppliers, maybe they were not in a good condition or they were not the goods that were expected, then we record it in the purchases returns journal. Then we have the general journal as the last one. So in the general journal, we record any other information that does not fit in the other 5 books of original entry. Like, for example, the sales and purchases of fixed assets. You know, we, especially on credit, if we purchase fixed assets or we sell fixed assets on credit, we record those things in the general journal. Then we are talking about correction of errors, and we have other things like maybe things like maybe bad debts, etc. So those things, they are accounted for in the general journal. Okay, then from the journals we have the ledger, and in the ledger we use what we call the double entry principle, and that double entry principle states that for every transaction there are 2 parties involved. So every transaction is supposed to be recorded twice. That is, once as a debit and once as a credit. And it is because of the accounts in the ledger that we'll be able to extract a trial balance. So a trial balance, it is a summary of all the transactions in the ledger, because at the end of the accounting period, which can be a year, a month, or whatever, all those accounts in the ledger are closed off, and then the balances are extracted so that we can create a trial balance. Then from the trial balance, we are going to be having final accounts. And these final accounts, they include the income statement and the statement of financial position. And also number 3, it also includes the statement of cash flow, or the cash flow statement, whichever word to use. So basically, these are the things that I wanted you to know about the accounting cycle. I will see you in the next video when we'll be talking about the format for the income statement. Cheers to you.